Vanguard shares with us their thoughts on the best way to spend in retirement to increase your income with inflation and to make sure you don't run out of money. That's what we're going to talk about here today. Another Vanguard research report that I'm pretty fond of, and I think you will be too. So don't forget to subscribe, and as always, help me with a thumbs up or comment down below. That helps me with our YouTube algorithm. And the more the YouTube algorithm likes me, the more people get to watch the content. So everything you can do, if you enjoy the channel, would be helpful to me too. All right, so let's dive right into this. Another study from Vanguard. As you know, I'm a fond of Vanguard, and a lot of people are. And so comes from another subscriber to my website who has sent me this article. And this is from October 2013, which is good because the last one I just did on Vanguard was in June of 2008. So this is a little bit more recent, 5 years old. But what I like about it is it takes into account the Great Recession turmoil from October 2007 to March 9th of 2009 as well. So just Vanguard does such good studies. I tell you, I can't wait till the next one I show you here on the Vanguard 2019 Outlook. Oh, man, that report, I mean, I live by that sucker. Every year they do report the Vanguard Economic Outlook for the following year. It's just fundamentally awesome. All right, so more dynamic approach for spending for retirement and for investors in retirement. Again, Colleen Giaconetti, and this is the first I heard of her, but this is the second straight time I've seen her work. So maybe I just missed her name, but good on you, Colleen. Don't know Francis Kinney or Michael DeJoseph, CFAs, and Colleen is a CPA and a CFP. And those are the three big ones. So remember, a CPA is was it certified public accountant or chartered? I think it's a public accountant. I forgot what the C stands for. So it's accounting, tax stuff. A CFP is a certified financial planner, of which your old buddy Josh is. That's just for financial planning. And a CFA is a chartered financial analyst. A CFA is a chartered financial analyst, which is for investment management. So of the big three, you'd want to get the services of one of those three, depending on what you're trying to accomplish. Are you trying to accomplish tax stuff? CPA is probably your starting point. You're trying to accomplish investment strategies. CFA is probably your starting point. You're trying to accomplish overall financial planning. A CFP is probably your best. Doesn't mean a CFP can't help you with taxes or a CFP can't help you with investments. Doesn't mean a CFA can't help you with financial planning or a CPA can't help you with investments. But when it comes down to it, their bread and butter for a CPA is taxes, a CFP is financial planning, and a CFA is investments. And I would assume that you would recognize it, but that you're talking to somebody who's one or of those designations that they label that is their respective area of expertise. Right. So executive summary of the many challenges investors face when deciding how to spend from their retirement savings, one of the most important is that of choosing a portfolio spending strategy that best balances investors' two competing goals. One is maintaining their desired level of current spending, and two is increasing or at least preserving their portfolios to future spending. The paper reviews two of the most common spending strategies and includes a third, a hybrid of the two others that we view as a more dynamic approach. Through a simulation analysis, we highlight the trade-offs of each of these strategies. We conclude that although adopting an appropriate strategy is important, the key ingredient in a long-term spending plan is flexibility. The more investors can tolerate some short-term fluctuations in spending, the more likely they are to achieve their long-term goals. Couldn't agree with that more. All right, so I'm going to just dive into this right here and show you I'm going to go over the three strategies. There are three different strategies. They have 10,000 Monte Carlo analyses of each. Figure 1 provides a high-level rundown of the three spending strategies. To illustrate the trade-offs of the three approaches, we simulated 10,000 potential scenarios for each, using the Vanguard capital markets model to estimate future returns for broad asset classes. Each scenario generated a cash flow based on the following assumptions. And here are the assumptions. Again, another 35-year time horizon. In this case, a portfolio allocation, essentially the Vanguard Moderate Life Strategy Fund, which would be 50% stocks, 50% bonds. In this case, you got 35% of the 50% stocks, U.S., 15% international, 40% of the bonds to U.S. bonds, and 10% international, and rebalanced annually. Starting balance is $1 million, and the first year spending is 4% of the portfolio, $40,000, and they aren't taking taxes out. All right. And that's always a bugaboo of mine. I don't blame Vanguard for that. They're saying taxes should be part of your spending needs for sure. But they're saying taxes are assumed to be paid from the withdrawal amounts. And notice they aren't taking fees either. So if we put taxes and fees on there, you get walloped quite a bit. But just for the time being, we'll use what we got here because I like it. It's good. This is a good model, good paper, actually. And whoever sent this to me, kudos on you because I like this. I missed it. So I like it. All right. So the three scenarios are dollar amount grown by inflation. We calculate a dollar amount in the first year. In this case, it's $40,000, and we adjust it each year with inflation. The key characteristics of this is it ignores market performance. Don't care. We're taking $40,000 out this year. We're taking $40,000 out adjusted for inflation the next year. And if we're using a 3% inflation, let's just say 40,000 times 1.03, 41,200 the following year, and so on and so on. We don't care about the market. So it does provide short-term spending stability. Long-term effect on the portfolio can be unpredictable because as we take increasing amounts each and every year for inflation, well, what happens if the market gets hammered like we've seen in the last 15, 20 years? So model number 2, percentage of portfolio with a ceiling and floor, and this is their dynamic approach. Withdraw a specific percentage of the portfolio each year subject to upper and lower limits based on the prior year's spending. Somewhat responsive to market performance. Spending may fluctuate in the short term, but is held within limits. If the markets decline significantly, the portfolio's principal could fall far enough to require reductions in future spending beyond the floor. And we'll dive into each of these here in just a second. And lastly is percentage of portfolio, the typical 4% rule. So we're going to withdraw 4% a year. Highly responsive to market performance. Markets going like this. Our adjusting is going to change based on what the market did the previous year. Spending may fluctuate significantly in the short term. Absolutely. The portfolio is never depleted because you're only taking 4% a year off. So you never have to worry about running out of money. And long-term spending levels depend on both market performance and investment strategy. All right. So that's what we're looking at here in terms of the three models. So let's go over what they find here. I think it's pretty interesting. Let's see. To determine the spending amount in each subsequent year, the investor multiplies the prior year spending by an inflation factor, typically the change in CPI. So this is the first one, which, well, I'll hold my fire here for just a second. We're taking $40,000 off the first year. All right, that's what we're doing. And we're adjusting it with CPI. We'll for simplicity, just say it's 3%. So the next year, we'll take $41,200. The next year, we're going to take $42,436 and so on, regardless of what the markets do. And we're going to go over the strategies of the three. All right. So dollar amount by inflation, portfolio survival rate, assets not depleted over 3 years. So of the three strategies, portfolio survival rate in the first one we just talked about, 78% of the time it was successful, i.e. it had money left over. 22% of the time it was not successful. It failed, i.e. it had no money left over. So if you're 65 years old today and it's a 35-year trajectory, but 22% of the time, by the time you're 100 years old, you ran out of money. There you go. Now, on the ceiling floor potential, and again, this is kind of subjective because when do you do it? There's no structure necessarily in here to say when you're going to allow yourself to go up to a 5% withdrawal rate or to go down to a 2.5% withdrawal. It doesn't really give us a structure there. So it's really contingent on what you do. So you say at the end of the day, I took $40,000 out last year. I'm going to take no more than $42,000 out the following year, 5% ceiling. I took $40,000 out last year, but the market's crashed, so I'm going to take only 2.5% out this year, which would give us a lower amount than we did the previous year after the market's crashed, if that makes sense. So we're basically saying when the markets go down, we're going to take out less. When the markets go up, we'll take out more. Essentially, we're selling at a gain and not selling at a loss to some degree. And when we do like that, we have a 92% chance of not depleting our portfolio. So 100 times, 8 times out of 100, we have no money left at the age of 100. 92 times we have money left. 4% just each and every year, every single year we have money left. That might be $10, but we have money left. And so that's just fact. If in terms of retaining your portfolio value of some sort is the most important thing, then the percentage of your portfolio would be the way to go. Now, real inflation-adjusted ending asset balance. So let's look at the median. Again, remember, we started $1 million. So after 35 years, 50% of the time, we had over 1.153 million, and 50% of the time we had lower than 1.153 million in the dollar amount by inflation. Number one strategy. In the floor and ceiling, we had about 1.068 million. And then in the percentage of portfolio, we had 1.22 million. So in this case, you're thinking to yourself, so we have a 100% chance of not running out of money because inherently we can't if we're only taking 4% a year out. And we have more at the end of the day as a terminal wealth. We have 1.2 million in terminal wealth than we did in the other. So far you're thinking that's the way to go, right? In fact, and even in this case, because we ran out of money in the first two scenarios, the minimum, we had zero money left at the age of 100. We ran out of money for both the ceiling and floor and the dollar growth by inflation, whereas the percentage of portfolio, the minimum we had was $43,900. Now, if you look at the 25th percentile, again, this just means 25% and less. In the first strategy, we had $102,000 or less from 0 to 25 percentage. And you can see on the second strategy, we had $449,000, 25% of the time or less. And then the third strategy, we had $700,000, 25% of the time or less. So again, that's what leads you to think percentage of portfolio is the way to go until you see this. And this is where it starts getting a little bit dicey. Real annual spending as a percentage of initial spending. So we're taking $40,000 out this year. That means the next year, if we're using a 3% inflation, we need to take 40 times 1.03, 41,200 the next year, 42,436, and so on and so on. So every single year in the strategy number one, we're able to keep up with our rate of spending, growing it with the rate of inflation, and it never dropped below, not one time. It's not the case for the other scenarios. All right. So the other scenarios you'll see, we had the 25th percentile, 66%, which is less than 100%. So 1/4 of every time of every year. So once out of every 4 years, probably a better way to say it, we had less than our initial amount if you adjust for inflation. Does that make sense? So one out of every 4 years, we had less than essentially the real $40,000 annual spending. And that's pretty significant. I mean, that means it's hard to make plans if every fourth year you're going to have less than the initial amount that you took out. And then if we go back to so far what was perceived as the best strategy, the 4% rule, basically the same thing, roughly 68%. So essentially one of every 4 years we had 68% of what we had. And give an example. So in that case, if we had 68% of our $40,000, so we had $40,000 minus 68%, that means we had our portfolio grow as low as 68. Hold on a second. I got to explain this better. Minus 68%. So hold on just a sec. We have 40,000 times point. All right, so we have 27,200. All right, so that means we were able to only spend the equivalent of 27,200 one out of every 4 years. All right, now I can't stress that enough, my friends. So if you have 40,000 you're accustomed to, and one out of every 4 years, I say you can only spend 27,200. That's a big deal. That's a big deal, and that's one every 4 years. In fact, in the portfolio ceiling and floor, it gets even worse. And we're talking 40,000 minus 66%. We're talking 26,400. I mean, that's a third less. That's not good. Now, in the median, all right, so the median, 50% of the time, you had more than 40,000. We had 40,000 times 1.14. We're able to spend, I hate to say on average, but 50% of the time or more, we're able to spend 45,600, whereas 50% of the time, we had to spend less than 45,600. So that's good. I mean, that gives you more of an upside, but also gives you a pretty significant downside. I mean, one of every 4 years, my friends, for significant drops in your income. And I'm not a fan of that. And here, look, percentage of time real spending drops below initial spending. So only 6% of the time in strategy one did it drop below initial spending. And that's because you ran out of money. 45% of the time did it drop in strategy two. And again, because you ran out of money and because of market volatility. 48% in strategy three. So percentage of time, so basically half the time, the portfolio went below at some point, your initial $40,000. I mean, again, it could be $39,999, but at some point, Half the time it did. It fell below the $40,000, which is, I don't think that's good. And then on top of that time, the half the time it fell below the real spending from $40,000 he started with. 1 every 4 years, you were spending 68% less. 32% less. So I'm not a fan of that at all. And so they talk more about percent. They talk about the different strategies in here and everything. So I wanted to point something else out. Yeah, right here. I wanted that so we survival rate. Yeah. Okay. Conclusion. I wanted to point something else out. Yeah, right here. All right. So this is the initial withdrawal rates with an 85% survival of hypothetical portfolio. All right. So we're taking a dollar amount by inflation. All right. So we got, if you're going to live for 30 years and you want an 85% likelihood of survival and you're invested 50-50 stocks to bonds, you can take out 3.9% a year to have a 85% chance, or 3.9%, I should say, in the first year. So if you got $1 million, you could take out $39,000 in that first year. And then each and every year adjust it for whatever the rate of inflation you're using. And you're going to have an 85% chance of not running out of money. If you make it a little bit more aggressive, you go from 39,000 to 40,000 and not run out of money other than 15% of the time. If you make it a little bit less aggressive, conservative, 20% bonds, 20% stocks, 80% bonds, you can take 35,000 out without much of a risk of running out of money, just 15 times out of 100. Now, if you do the ceiling at 4, though, and you live for 30 years, you can increase your money to 49,000 in a moderate portfolio, which means that you can take 49,000 the first year and only have an 85% success rate that you don't run out of money. So that's pretty good. That just shows you the inflation adjusted amount on a moderate portfolio. You can take 39,000 out and have an 85% success rate. The ceiling 4, you can take 49,000 out off that million and have an 85% success rate with a moderate portfolio for 30 years. And then then it doesn't matter. The other one is 4% a year, and you're never going to run out of money because you're only taking 4% a year, because the 4% rule just says 4% of the portfolio. When are you never going to run out of money? The answer is never, because you're only taking 4% of whatever the value is. That's it. You're not 4% the first year, adjusting each and every year with inflation. You're taking 4% out. And that's all you're going to do. Whatever the portfolio is worth the previous year, you're taking 4% out. Market goes way up, market goes way down. You look at your annual end of year balance, you're taking 4%. And because of that, we know for a fact, if you stick to that, you will never run out of money. You'll have a terminal value. Now, again, this does include taxes, does not include fees. In the Vanguard, they use the capital markets in terms of their projections going forward. And in my next video, I'm actually going to share what their projections are going forward. They do use historical numbers, I should say, from 1926 to 2012, which is good. So there is some history there. And that's good. I'll show you the projections going forward. I'm sorry. The next video, when I use their 2019 economic outlook. And then they kind of talk about, this is a little bit confusing, but they talk about how the floor would work if you start with $40,000 and you took 2.5% off, your next year would be 39,000. Or if you took 5% ceiling, your next year spending would be 42. That's a little bit way too confusing. No one's going to do that. No one's going to do it. So what's my take? And they're using a 3% inflation, by the way. My take is this one by far and away. They take the 4% the first year. I'll show you right here. You take the 4% the first year and adjust each year with inflation, i.e. the 4% rule, without question. Simply because, yes, there is a 22% chance that you might not survive your portfolio. Man, at 100 years old, I am telling you, you're not spending the same amount of money you did when you're 65. It's just not happening. The vast majority of us will either die before then or be spending a whole lot less. Yes, there is some people who spend a whole lot more. I get it. The vast majority of us, that just won't be. And so I like this because it says I have income stability and I still have pretty significant terminal wealth here. I mean, between the three, the terminal wealth is all within spitting distance, all over the initial starting amount for sure. And if the market goes real well, I'm kicking butt and taking names. I got 3.1 million, whereas everybody else has basically $1 million less. So everybody else is 50% less than what I have, or 33% less than what I have. And I don't care about the maximum. Yes, there is a risk of run out of money. Absolutely. And what I just say is at the end of the day, if you're down to your last $40,000 and you're only 82 years old and you're still saying, heaven forbid, I'm going to take my 40,000 out. That's real money because Josh on YouTube said I should. I would say that's foolish, but that could happen. You could run out of money, but who is more important? Make sure you're taking care of you or taking care of your terminal wealth to your heirs. And I'm just telling you, it's taking care of you. Don't fight coach so your heirs can fly first class. It doesn't make sense. And as you can see here, the 4% rule adjusted with inflation allows us to keep 100% of our spending real. That's what we want to see. And the only time it drops below that real spending is when we lose money and run out. Well, how do you solve that? Don't run out of money. How do you not run out of money? You look at your portfolio and say, man, I start with $1 million. It's down to 400,000. I better cut back, tighten my belt. Not rocket science here, my friends. But the idea that you're going to sit there and say, oh, I'm going to take out 26,000 this year, even though 2 years ago I had 40,000. That's not going to happen. No one's going to do that. No one's going to take out 33% less once every 4 years. So of the three models, by far and away, the 4% rule, whatever the rule you want to use, but the certain amount you start with and adjust each year with inflation inherently makes sense to me. So I hope you like this, and stay tuned for the next video I do on the Vanguard capital markets look ahead forecast for 2019. My favorite research paper. I look forward to every year. I'm looking forward to sharing that. Subscribe. Go to the blog at heritagewealthplanning.com. And of course, comments always help me as well. And we'll see you next time. Thanks, guys.